Gold's getting a lot of attention from investors given its upward move over the past 3 years, but in particular, seen a parabolic move, a vertical move in the gold price since late August of this year. And that's probably increased demand for gold even more. A lot of the same patterns we're seeing associated with speculative parts of the stock market are showing up in the gold trade as well. We consider gold to be a psychological commodity. That means it doesn't really have any practical uses like copper or oil, but it used to be a currency about a century ago or more. And after that, it was used to back currencies. But for at least last 50 years, it's really been more of a collectible, or as we said, a psychological commodity that basically is worth what people are willing to pay for it. That doesn't mean the price can't go up, as we've seen in the last couple of years. To the extent we can identify any consistent drivers of what makes gold prices go up or down, it really is short-term real interest rates, or in this case, as you can see on the graph, the rate on the 2-year TIPS yield. TIPS are Treasury inflation-protected securities where the principal is adjusted up and down by the consumer price index. So you can't be inflated away of the coupon you're receiving. The real value of that coupon stays consistent over time. And the question that people who look to gold as an investment tend to ask is, what am I earning on my cash after inflation? When this number is low, and occasionally it's been negative, gold tends to look more attractive as a store of value. Gold doesn't tend to perform well going into recessions, but it tends to perform well coming out of recessions when interest rates are low and inflation is increasing. More recently, the Fed has been willing to cut interest rates both in 2024 and in 2025, with inflation still elevated and inflation still well above the Fed's 2% target. This is just about the best mix of factors we can imagine for gold. It doesn't look like the economy is falling off a cliff. Short-term interest rates are falling and inflation is still high. This is really the big reason why we think we've seen this powerful gold rally in 2025. A couple of things we want to emphasize about gold. One is that gold is not actually a good store of value. Good store of value is something that holds its real value over time, even with prices increasing. The purchasing power of this asset, you want it to stay consistent over time. Cash, as you can see on this graph, has been a pretty good store of value. Cash rates tend to increase at times when inflation is increasing because we have independent central banks that tend to be credible on inflation. The gold price has risen by a lot more than inflation, by a lot more than the returns you've been able to get on cash. But it's also had very long periods, both in the 1990s and then the 2010s, where it lost 30, 40, even 50% of its value over both short and long periods of time. So it has not been a good, consistent store of value. It's not also particularly closely correlated to things you'd normally associate with stores of value, things like the US dollar or inflation. When you look at the relationship between gold and those things, it's been very inconsistent over time. The other thing we want to get across is that over very long time horizons, gold has not been that powerful in addition to a diversified portfolio of stocks and bonds. This graph is showing you two portfolios. One is a 60-40 mix of the S&P 500 and the Bloomberg US Aggregate Bond Index. The other is that same 60-40 split, but with a 5% carve-out for gold. And they look like the same line. Gold can be a very useful tactical asset class over short periods, as we've seen, and even medium-term periods of 1, 2, 3 years. But holding it for a very long period of time tends to introduce more volatility from holding that very volatile gold asset without adding much in the way of return. So I hope you found this helpful. We're going to be doing a lot more on gold and other asset classes in these videos, and we'll obviously be closely watching gold for signs that momentum is fading or that some of the retail chase into the gold assets, both ETFs and the physical metal, is starting to slow down. Thanks very much for listening.